to Girl Investors. This channel is dedicated to teaching you about investing and money. So what are stocks? When it comes to investing, you will gather and process information to make decisions, including those that are related to buying and selling assets. Generally, there are four major asset classes, including stocks, which are public equities, bonds, which are also known as fixed income, alternative assets, which could be things like private equity, venture capital, hedge funds, commodities, and real estate, and cash, which could be currencies. So in this video, we're going to focus on an introduction to stocks. Understanding equity securities or stocks is important for wealth building because most likely you are going to have a sizable percentage allocated to stocks in your portfolio. And by the end of this video, you will know what stocks actually are. And in future videos, we will discuss how stocks are traded, how to analyze industries and companies, ways to value stocks, and more details on markets. So if this interests you, then please remember to subscribe to this channel and please keep watching. But what is a stock? Some people don't realize that owning stocks means owning a piece of a business. So when companies don't have enough cash to grow their businesses, such as to purchase supplies and buildings, to pay for research and development and so forth, they can finance their operations by issuing either debt or equity securities. So as you're going to remember from the series on how to read a balance sheet, and I'll post a link in the description box below. A key difference between debt and equity securities is that debt is a liability for the issuing company, whereas equity is not. So this means that when a company issues debt, it is contractually obligated to repay the amount it borrows. So for example, the principal or the face value of the debt. And they're obligated to repay at a specified future date. So the cost of using these funds is called interest, which the company is contractually obligated to pay until the debt matures or is retired. When the company issues equity securities, though, meaning shares, it's not contractually obligated to repay the amount it receives from shareholders, nor is it contractually obligated to make periodic repayments to shareholders for the use of their funds. But instead, shareholders then have a claim on the company's assets after all the liabilities have been paid. Because of this residual claim, equity investors are actually considered to be owners of the company. Investors who purchase equity securities are seeking a total return, such as a capital or price appreciation or a dividend income. So whereas investors who purchase debt securities and they hold on until maturity, such as 3 years, 5 years, or 10 years, they're seeking interest income. So as a result, equity investors expect that the company's management are going to act in their best interest by making operating decisions that are going to maximize shareholder wealth. This is going to be very important when you are going to be analyzing companies and management behavior. So it's actually a great thing that companies can issue either debt or equity. For example, big banks might only lend to companies that have a track record of profitability, and if companies only had debt to choose from, then the world might actually lose out on bringing new innovations to market. And for investors, equity securities represent a key asset class because of their unique return and risk characteristics. So when a company issues stock, it divides the ownership of the company into thousands, if not millions, of equal parts, which are called individual shares. So each share has an equal claim on the profits and an equal say in the management of the company. And so the more shares you buy, the bigger the slice of the company's profits that you're going to receive, and the more influence you have on the company decisions. But it's a little bit more nuanced, so I'll talk a little bit more on that later when I talk about common and preferred shares. But at the most simplest level, the basic skill of stock investing really boils down to finding companies that build successful products or services. So this can mean that a tech company such as Apple or Google, or even a healthcare company that develops a new treatment. So although analyzing the company, you can decide if the stock price is undervalued, overvalued, or fairly valued in the marketplace. And stocks are traded on exchanges such as the Nasdaq, the Amex, the London Stock Exchange, or the Toronto Stock Exchange, and each company that's listed on these exchanges has a ticker. Investors can use a variety of methods to invest in the equity of companies outside of their local market, and so the most obvious is to buy and sell securities directly in foreign markets. However, this means that all transactions, which includes the purchase and sale of shares, dividend payments, and capital gains, are in the company's, not the investor's domestic currency. And this is actually often what happens for myself. I'm Canadian and I often purchase shares in the US equity market. And so foreign exchange is something that I have to be very cognizant of at all times. But investors investing in foreign markets have to be familiar with the trading, clearing, and settlement regulations and procedures of those markets. So now let's get into common shares and preference shares. So you should already know, if you've watched some of the previous videos, that companies can generally issue common shares or preferred shares. Common shares are the predominant type of equity security. Common shareholders share in the operating performance of the company, participate in the governance processes through voting rights, and have a claim on the company's net assets in the case of a liquidation, for example. Companies can also choose to pay out some or all of their net income in the form of cash dividends to common shareholders, but they are not contractually obligated to do so. Voting rights provide the shareholders with the opportunity to participate in major corporate governance decisions, including the election of its board of directors, the decision to merge with or take over another company, and the selection of outside auditors. So shareholder voting generally takes place during a company's annual meeting, and quite often it's because of geographic limitations and the large number of shareholders. It's actually not often feasible for all the shareholders to attend the annual meeting in person. And for this reason, shareholders may vote by proxy, and this means that it allows a designated party, such as another shareholder, a shareholder representative, or management, to vote on the shareholders' behalf. And in addition to common shares, which are also known as ordinary shares or common stock, companies can also issue preference shares, which is also known as preferred stock, and which is the other type of equity security. The preference shares, very briefly, rank above common shares with respect to the payment of dividends and the distribution of the company's net assets upon liquidation. However, preference shareholders generally do not share in the operating performance of the company, and they don't have any voting rights unless they're explicitly allowed for it at issuance. So there you have it. In a nutshell, I hope now you understand what a stock is if you didn't previously before. If you learned something, please like, share, subscribe this video, and hit the notification bell. Thank you very much for watching, and I'll see you again next time.